Welcome back to the deep dive. Today we're digging into the Q3 2025 financials and, maybe more importantly, the 2026 outlook for a major player, the Sherwin-Williams Company, SHW. And our mission really is to try and get a handle on how they're pulling this off. Are they genuinely executing flawlessly in what feels like a really tough economy? Or are they maybe, taking some big calculated risks, hoping for a 2026 turnaround?
Yeah, that's the tension, isn't it? Because management kept saying the demand environment is softer for longer. That was the phrase. But despite that, they delivered what they termed solid Q3 results.
Absolutely solid. I mean, the top line doesn't exactly scream slowdown.
Right.
Consolidated net sales, they were up 3.2% to $6.36 billion. That's right at the high end of their guidance.
Right.
And adjusted diluted EPS grew, 6.5%? Pretty respectable. It feels like they're finding growth even when the market isn't really helping them out.
It really speaks to their operational control, I think. But that control comes with a very realistic view of what's next. Looking at 2026, they were quite clear.
Yeah.
They expect this very challenging environment, as they put it, to stick around, probably through the first half of 2026, maybe even, and I quote, most likely beyond that.
Wow.
So, yeah, they're planning for continued choppiness pretty much everywhere.
Okay, so no quick snapback recovery expected internally. They're digging in for a longer, tougher period, which I guess makes their Q3 performance and cost management even more critical, right? They're clearly preparing. Just hitting those Q3 numbers again quickly, the adjusted EBITDA margin expanded 60 basis points to 21.4%. That's strong.
Very strong margin performance.
And they're still returning cash, $864 million back to shareholders via buybacks and dividends. They did update the full-year sales guidance, now just up a low single-digit % versus 24.
Right, a slight tweak down, but still positive.
But they kept the adjusted EPS guidance midpoint unchanged at $11.35. That consistency, it sort of suggests they feel they have a good grip on things despite the headwinds?
They do. And, well, let's be honest, that grip seems strongest in one particular area, the paint stores group, PSG. That segment is really carrying the load right now, offsetting weakness elsewhere.
Okay, let's focus there then on the PSG engine, because this is where they say the strategy is really paying off. Mid-single-digit sales increase there. But the key point they hammered home was this growth wasn't the market lifting them up.
No, not at all.
It was the return on their own growth investments over the last few years.
Exactly. And that's the story, isn't it? Gaining share when the market is flat or even down, that's competitive advantage in action if you break it down by segment within PSG.
Yeah, let's do that.
Protective and marine coatings up low double digits. That makes it, 5 quarters in a row of high single-digit growth or better there. They're really running away with it in that space.
Incredible consistency. And residential repaint. That resilience is something else.
It really is.
Sales grew mid-single digits again, and they've kept that pace, or better, every single quarter since the start of 2022. Just think about that. Existing home sales have been basically negative that whole time.
Right. So they're clearly taking share. They're not relying on housing turnover. They're just winning business from others. It seems like they're somewhat insulated from the worst of the housing slump because of that share gain.
That structural advantage you mentioned. And even in commercial.
Same story. Sales up mid-single digits.
Yeah.
And that's in a quarter where the data we have shows multifamily completions were actually down double digits.
Yeah.
So again, outperforming the underlying market significantly. It's not passive, it's active share capture.
And does that flow down to the bottom line in PSG?
It does. PSG segment margin increased 40 basis points. And the really impressive part, I think, was the SG&A leverage. Getting over 30% incremental margin on just low single-digit volume growth.
Yeah, that's efficient.
That's incredibly efficient. It shows those earlier restructuring efforts and cost controls are really making the whole operation leaner, more profitable gallons.
And they're not resting on their laurels either. They're still expanding the footprint. Opened 23 net new stores in Q3.
Yep, 61 year to date. That's actually ahead of last year's pace. And crucially, they mentioned adding a, quote, commensurate number of new sales reps alongside those stores.
So investing in the people to make the stores productive quickly. Smart.
It's key to their whole model. Okay, so PSG is clearly the star. But we need to look at the other parts of the business, which faced, let's say, more significant challenges. Consumer Brands Group, CBG.
Right, CDG. How did that look?
Sales, they were actually down 2.6%. The main issues were, ongoing softness in North American DIY. That segment just isn't bouncing back yet, and also some unfavorable FX, foreign exchange impact in Latin America. Europe was actually a bright spot within CBG, managed some growth there.
Speaking of Latin America, they just made a pretty big move there, didn't they? Post-quarter close, the Suvinil acquisition.
They did. Closed in October. They bought BASF's Brazilian decorative paints business, Suvinil. It's a substantial business, around $525 million in annual sales.
Wow, okay.
Yeah, described as a mid-teens EBITDA margin business currently. But Sherwin-Williams thinks they can get that up into the high teens, maybe even low 20s, over the medium term through synergies. It's clearly a strategic play to bolster their position outside of North America DIY.
Makes sense. Diversification. Okay, what about the third segment? Performance Coatings Group, PCG.
PCG was, let's call it a mixed bag. Sales were up slightly, 1.7%. That came from volume, some acquisitions, and a bit of FX help.
Yeah.
But it was largely offset by unfavorable price mix.
Meaning they sold more stuff, but maybe lower margin stuff.
Essentially, yes. Or perhaps a less favorable geographic mix.
Yeah.
There were some definite bright spots, though. Packaging coatings did very well. Double-digit growth, partly helped by an acquisition. And auto refinish also grew mid-single digits overall.
Yeah.
Actually, high single digits in North America, which they attributed to gaining share, even while insurance claims were apparently a bit lower. So good execution there again.
But the overall profit.
That's the issue. Despite the sales increase, PCG's segment profit and margin actually decreased, primarily due to that unfavorable product mix, region mix, and probably some higher costs associated with generating that volume. It just shows how tough it is to maintain pricing power everywhere compared to their dominant PSG position.
Right. And speaking of costs and tough decisions, we have to talk about that 401k announcement. That definitely raised some eyebrows.
It certainly did. A very significant move.
They announced, effective October 1st, so just after the quarter ended, this very difficult decision to temporarily pause the company match for the 401k plan. That feels pretty drastic. I mean, usually that's a lever companies pull when things are really tight or they need cash fast. They said the goal was to preserve as many jobs as possible and protect investments. But doesn't it signal maybe a deeper concern about 2026 than the Q3 numbers suggest?
It's a stark signal, no doubt about it. And I think it really underlines just how seriously they're taking that softer for longer forecast. They did emphasize that this came after other cost-saving efforts and restructuring.
Okay, so not the first lever they pulled.
Apparently not.
Okay.
But it's a tough trade-off, right? You save cash on payroll immediately, which helps weather the storm, but you absolutely risk hitting employee morale, maybe losing talent. It shows how focused management is on protecting the core operations and cash flow through this expected rough patch.
Almost ruthless pragmatism, willing to take some internal pain to keep the external performance engine running, which I guess leads us straight into their big strategic plays for 2026, starting with price.
Right. The big one.
A 7% price increase announced for the Paint Stores Group effective January 1st, 7%. You mentioned that's the biggest hike since the big inflation spike during COVID. Doing that now in a tepid demand environment, isn't that a huge gamble on volume?
It is a huge gamble, a massive bet, really. And the justification they laid out is all about their own expected cost inflation for 2026.
Okay, what are they seeing?
Their initial read is raw materials only up low single digits, which seems manageable. But the other baskets, wages, they expect up low single digits, okay? But healthcare costs, they're forecasting those up low double digits.
Ouch, okay.
So they're framing this 7% hike largely as a defensive move, trying to protect margins from those unavoidable cost increases. But they acknowledge it's a balancing act.
How so?
They know they might not get the full 7% to stick everywhere, depending on the market. So to offset any potential volume hit from the price hike, they explicitly said they plan to be very aggressive in growing the business through new accounts.
So it's offense on volume, defense on price. Push for share aggressively while trying to hold the line on margin erosion from costs.
That seems to be the strategy. Maximize profit now where they can, but keep grabbing share for the future.
And did they give any sense of what might finally break this softer for longer pattern, especially in housing?
They did offer a view. Management suggested that mortgage rates getting down to around 6% or a little bit below. That seems to be the magic number in their eyes.
6% or just under?
Yeah. They think that level would be enough to really boost existing home turnover, unlock all that pent-up demand we know is out there. Until that happens, though, their base case assumption seems to be pretty flat volume.
Okay, so they're waiting for that catalyst like everyone else, but managing the business, assuming it doesn't come quickly. And just circling back on costs quickly, those restructuring savings they announced before.
Still on track. They expect about $40 million in savings benefit this year, 2025, doubling to roughly $80 million on a full-year run rate basis going forward.
Yeah.
So that efficiency is baked in now, which should help amplify things when the market does eventually turn.
Good point. Okay, before we wrap up, just a quick note on something tangible, the big move. They've started moving into the new global headquarters and R&D center in Cleveland.
That's right, expected to be fully completed in the spring. And the key financial implication there is CapEx.
Right. Big spend finally winding down.
Exactly. Once those building costs are done, they expect CapEx to drop back to the more normal range, around 2% of sales next year. That frees up a significant chunk of cash flow starting in 2026, potentially for more investment or shareholder return.
Okay, so putting it all together, here's the thought maybe to leave you, the listener, with. You've got SHW pulling these two big levers simultaneously right now. This aggressive 7% price hike to protect margins, while at the same time pushing hard for market share, new stores, new reps, big acquisitions like Suvinil, all during a downturn.
A real dual strategy.
So if, or maybe when, the softer for longer period finally eases up, like say we do hit that magic 6% mortgage rate, what kind of, amplification effect might we see when all those hard-won share gains and those embedded cost efficiencies suddenly meet a recovering market volume? That potential collision, that acceleration, that feels like the real story to watch for 2026 and beyond.
Definitely something to keep a close eye on.
Indeed. Thanks for joining us for the deep dive. We'll catch you next time with more insights.